Yes.
So if it plays out like this, and first lien debt's 8.25%,
Yes.
how does equity get priced?
That's a,
How do you stay at 9 cap rate?
how did you know that was my next slide? So the question was, if debt's 8.25, which is what this would imply, right? What does that mean for cap rates, and what does that mean for real estate valuations, right? Well, we all kind of know. And you know one of the things about cap rates is they're just the mathematical cost of capital. And debt is the big variable, right? How much debt's available and what's the cost of debt. So debt, to a large extent, drives cap rates. Well, we know that in that model, right, we're looking at 8.25 coupon for a 75% LTV loan, which is probably about right today. I mean, maybe not be right, meaning it's what everybody wants, but if you went out and surveyed the market, you'd probably find that's probably the prevailing rate for that, if you could find money there. And no lender is going to accept anything less than a 30-year AM, so you're talking about a 9 constant on the money. Now, mathematically, to get to a minimum debt coverage ratio of about 1.2, which is what people will typically want if they have money to lend, mathematically, you need an 8.25 minimum cap rate to cover debt service on that property at 1.2 at a 9. However, if you have an 8.25 cap rate and you're paying 9, you've got negative leverage, right? And so you're getting a cash on cash of 6% or just under that. Now, the only way someone would take a 6% cash on cash is if they believed very strongly in a surging NOI, right? Nobody's looking for a 6% ROE. So unfortunately today, nobody in their right mind believes rents are going up. So nobody's going to accept this deal, right? Which means cap rates are not 8.25, but they're 9, because if the cost of money for 75% is 9, and most equity investors today want a minimum 9% cash on cash to compensate them for the fact that there's very little imminent upside in income, cap rates probably are 9. You know, that's just, yes?
Seems like the calculation of the 8.27% coupon is based on the 4% of the TALF and the
Yes.
and the 10% of the CMBS. The 4% is stated somewhere regulatory.
Well, yeah, let me explain that to you. It's a good question. Let me explain the math, how the 827 came about. So the 827 is just the mathematical average of the cost of money. And the way I look at it is a lender is going to write a 75% loan-to-value loan. Well, there's lender equity, right? And unlike the last model where the B piece of the CMBS was 2.5% of the deal, there was very little lender equity in the deal. Now, we're going to have a much bigger pile of lender equity. And maybe the B piece used to be a 22% cost of money, but it was only 2.5% of the deal. Now we're going to have lender equity that's probably less expensive on a current yield basis, but takes up a bigger part of the capital structure because lender leverage is not as available. So lender equity is probably priced around 15%. Now, the lender is going to leverage by issuing AAA rated bonds. And AAA rated bonds are going to approximate 50% loan to value. So that means 2/3 of the capital of the loan is going to be in the form of a AAA rated bond, which is going to be providing leverage to the lender. Now the AAA bond buyer, the way TALF works, the AAA bond buyer can pledge his AAA bonds to the TALF program, and TALF will give them an 85% of cost 5-year non-recourse loan against the AAA. So I'm assuming that the leverage yield requirement of the CMBS AAA bond buyer is going to want to be 10%, and that's on 15% of that 50% capital. And TALF is priced at 100 over 5-year swaps. That is statutorily. And so today that's actually a little less than 4, it's probably like 3 3/4, but I rounded it to 4.
Right, so in that model, basically, you're saying that the cap rate, the constant is 9, and basically the cap rates are basically 9, and yet you have almost 100 or like 75 basis points over the of principal reduction. It seems like the lenders are going to get higher returns because they show.
Well, the way I have it written here, the lender is going to get a 15% cash-on-cash return for his.
The equity people that are going to get
A 9. Well, they got all the upside, right? You're 100% right. I think that I believe that over the next 3, 4, 5 years, there's going to be a huge allocation of capital into the real estate debt space for the reasons you're suggesting, which is that the risk-adjusted returns available in debt, both new loan origination as well as opportunistic purchase of existing loans at discounts, is going to far exceed the risk-adjusted returns of equity investing. Largely because that upside that you're going to have in the equity is probably not highly prized today.
Unless the cap rates will be higher than 9, if the cap rates are 10 or 11,
Yeah, yeah. I think that's an insightful point. Any other questions before I change slides? Okay. So to summarize, and this is probably the most important big picture point, you know, the 35,000 foot point. We are in the process of correcting from historically high valuations. There's no way around the fact that there's losses in the system, and they're big losses, right? So if you figure the total outstanding stock of real estate at its peak value in the US was somewhere between $5 and $6 trillion, we're going to see price declines ultimately when we settle in here that's going to wipe out a fair bit of that, certainly a number in excess of $1 trillion, and maybe much more. Someone's going to lose money. It'd probably be lenders, by the way, guys who own loans. Now, recent lending standards were just terrible, and anything that was originated from after '05, the chances of them going into default, those loans are very high. There was a Deutsche Bank, I would recommend this. It was a really, really nice, comprehensive, well thought out, fairly large research piece put together by Deutsche Bank on the loan market, the debt market in real estate. And I'm kind of an extremist, and I say things that people think are full of hyperbole, and I always say that I think that a large majority of the loans originated in this period will ultimately go into default, which is a crazy number to say a majority, because historically, loan defaults by vintage rarely exceed, 3-4%. Deutsche Bank published a paper that they said they believe that more than 50% of the loans originated in 2007 will ultimately go into default, more than 50%. And that year was the biggest year of origination in the history of the United States. So we're going to see a big default problem. Now, as far as loss severity, again, in the history books, loss severity, when a loan goes into default, a first mortgage, and you go through the foreclosure process, and the lender sells the property, how much money do they average lose? It's generally less than 10%. Well, you're in a first mortgage position, that makes sense. So far, the loss severity on what's been foreclosed upon in the last year has averaged close to 40%. So not only are we going to see incredibly high default numbers, but we're going to see very, very high real losses. And that means that the $700 billion CMBS market that's backed by these loans is in trouble, big trouble. Now, I told you about the values, right? Well, there's this PPIP program that I mentioned that has caused a flurry of bond buying activity because there's this belief, anticipation, that the 9 managers selected by the US government to take these bad assets off the books of the banks and put them in the hands of retirees and individual investors, that they were going to raise all this money to do this, and in anticipation of that, smart bond buyers started bidding up, buying those bonds, knowing that that multi-billion-dollar demand was right around the corner. And so now we're seeing these bonds trading at very high levels. Values have increased some 30 points over the last 3-4 months on a lot of these bonds. I would believe that's a temporary phenomenon.